Unfortunately, not every stock we purchase is going to become a major winner, and we need a plan to address that. However, we really want to keep in mind the initial mission of what we're trying to accomplish. And really, we want to find these incredible growth opportunities and hold them for the majority of their advance. So you absolutely want to use these techniques in the right context. When you have a stock that's a major winner, you want to use those shaper sells that we spoke about, and you want to ignore these tactical sell signals. However, it's important to be aware of them because there are going to be occasions where the market's not right, or you just selected the wrong investment vehicle, and you need a way to harvest some of those profits rather than have them all disappear just because it's not a major winner. Some key points to keep in mind when you're applying these tactical sells is you shouldn't be using these sell signals on your top performer or your top leader. This is going to be something that you want to reduce exposure. You want to take some money away from stocks that are not performing as strong. So you never want to use this on your top performer. By the time you eliminate your best performers or your best leaders, that's because you're really moving to cash because either that stock has run its course or the market conditions are so poor that you're going completely to cash. This is never going to be something you should use on your best stocks. Also, you want to use this when the stock is exhibiting poor relative strength versus the market. So if your stock is really advancing or holding in as the market's coming down, that's a stock showing strong relative strength. You want to use this when the market's been advancing for a period of time and you're sitting there waiting for your stock to go up and it's never quite getting anywhere. And that's where you want to say, okay, this stock is not really leading with the market. Let's use some tactical sell signals to take some exposure off. And the last case where I like to use this is when I'm very aggressively long. Maybe I'm on margin because the market's been really strong and I want to reduce. The market feels extended. All of my stocks are extended from bases and I can see that the extension from key moving average is rather large, so I want to reduce some exposure. So I'm going to turn around, look at my weaker names, and I'm going to use some of these tactical sell signals. Similar to the shaper patterns we discussed earlier, I've broken these down into two categories, defensive and offensive. And essentially, defensively, I'm trying not to have too many rules here because, again, we're being very careful when we're purchasing our stocks and we're layering in with our dollar stop approach. We're using multiple buy techniques. So really, defensively, we've already tackled a lot of that by keeping our risk very small to begin with. So if you're too restrictive and you're too defensive, then you're never going to give your stocks enough normal breathing room in their advance, and just regular volatility will knock you out of your positions and then you'll miss out on the major advance. So one of the ways I do like to use a defensive technique is essentially once I'm about 4 or 5 times my risk. So for example, if the risk on my position was 3%, once the stock has advanced 12 to 15%, I'll move my exit to break even. So I mean, once I'm up 15%, of course, we could come back, take me out of break even, and then still resume its advance. However, typically when there's been a 15% advance, I want it to at least be showing enough relative strength, and I also don't want to have all of your gains also turn into losses. So one way I like to use a defensive approach is really in that respect. It's rather simple, but it's effective. Offensively, before we get to the actual technical setups that we have here, there's a couple of very simple ways I like to approach it as well. So the best way to exit is really on strength, especially if it's tactical and you feel this is not a winner. By the time it gets to a defensive sell signal, even if you're not sitting at break even, if you use some other traditional techniques like a moving average or whatever other technique you want to use, by the time it gets to that defensive point, you've just given up so much of your profit. If you're up 15%, by the time you exit, you'll be up 5. So basically you gave up 2/3 of your profit. So ideally, if the signs that this is not a leader are present, this doesn't feel like it's acting strong enough, none of your hold rules are triggering, which we're going to cover in the next section. If you're, again, 3 or 4 times your risk, so if you're up 10, 12, 15%, very simple. It's not a complicated technique here, but if this is a stock you've been holding for 3 or 4 weeks and you're only up 12% and your risk was only 3%, it's a good time to harvest some gains. Really, I always have a clock going from when I buy a stock, and you'll see how we look at that in the hold rules section. But essentially, as time progresses, again, the only good stock is a stock that goes up. So if your stock is advanced, but it's lagging the market, but you do have a decent amount of profit, you want to take those profits because it's the normal rhythm of the market for these stocks to pull back, and then you're going to be stuck with no profit at all. Now, these are some rather simple techniques, and they're very effective. However, they do involve emotion. They involve emotion because if you're sitting there with a profit and there's nothing actually yelling out at you to take that profit, it's very easy to become complacent and just say like, oh, okay, I'll wait to see if the stock keeps advancing. So that's why I like to have a couple of tactical rules beyond simply taking out profit at 10 to 15%, that once it jumps out at you on the charts, you have to recognize it and it's a little easier to spot. So we're going to cover two methods that I use: the 3 EMA shake-in, which is the inverse of the 3 EMA shakeout that we discussed as a buying technique before, and the negative relative strength Keltner sell signal, which we'll cover. So let's take a look at how those work. And when your stock is not a leader, having these cues jump out at you will maybe make it a little easier for you to sell into strength before you lose most of your profit when you sell defensively. Let's take a look. So here's a good example of the 3 EMA shake-in that we're looking at. And essentially it's the inverse of the buying technique we used before. As I discussed, highs and lows are really a turbulence zone. So if you're trying to break above highs in a poor market condition or any time really, you are very susceptible for a quick snapback lower. So if the market is not in a strong uptrend or your stock is advanced and it's not showing enough strength to trigger some of the hold rules that we're going to look at later, it's a good way to take some profit before they're all gone. So assuming you would have bought somewhere on the lower end of this chart, perhaps with a 3-touch trend line or whatever other technique would appear, once we advance in price and we break the prior high, you can see the S&P was rolling over. We were in quite a decent correction at that point in time. And as the market rolled over, that inevitably really dragged Chipotle all the way down. It's hard to imagine that you would have been able to withstand this if you had a somewhat of a higher cost. So once we break a prior high of significance, typically the high of a basing structure, if within the next 3 days we close below that 3 EMA, the low of that bar ends up being our exit point. So you can see here, we broke the highs on this red candle. Day one, we stalled but didn't close below the EMA yet. Day two, we closed below that light blue 3 exponential moving average. And so the low of that bar was your exit. Here, again, not ideal. You were somewhat of a significant distance from the highs, but at least exiting here allowed you to keep some profit before completely unraveled. And this happened again on the right side here. Here, the same day that broke the highs, ended up closing below the 3 exponential moving average. Unfortunately, we gapped down the next day, but even that later exit still allowed you to harvest some profits, which would have completely disappeared had you just held on. So it's a good way that once you're approaching highs, you're not always just bullish and excited because you say, hey, we're breaking out to new highs. You really want to be aware and see, is there going to be follow through or are we stalling? And this is really a time I should be harvesting profits rather than adding more and raising my cost only to get all of your profits stopped out on a minor setback. Here is Invitae, which is a genetic testing company. Very similar here. You can see on the right side, we had a significant advance and we broke the prior highs. And on the third day, so we broke on the green candle. On day 3, we closed below that 3 exponential moving average. And once we took out the low of that bar, that was a good place to exit. Eventually, we kind of went sideways and then eventually broke lower. We had quite an advance on the right side, and I'll speak to experience on this area here. I was buying Invitae back in 2019 in this area, and as we advanced here, I ended up selling a little bit too late below the 50-day. Once we broke highs here on this green candle, on the third day, we closed below 3 exponential. Again, unfortunately, in this example, we gapped down, but that was your exit below the low of that candle. We rallied one more time, and you can see the market was really coming off here at this point, and so the volatility was picking up, and this was really a cause for concern, especially sitting at these prior highs and seeing these stall bars. So we broke again the prior high here on this red candle. 2 days later, we closed below, and that was a great exit point. Eventually, this went substantially lower. So it was a great way if you had any position lower down on this basing structure, if you wanted to take some profit off, this was a great place to do some selling. Here I'm going to discuss the negative relative strength Keltner sell signal. So the Keltner bands are very similar to Bollinger bands in a sense that you're using volatility bands around an average. What's different about it is how that volatility is calculated, whereas Bollinger bands use standard deviations, Keltner channel uses the true range. It's a technical difference. You can look a little more into it online. I prefer Keltner bands because I find them to be more stable than Bollinger bands. Bollinger bands tend to widen up and tighten a lot more often, so it's a little less dependable in my view from the way I like to apply it. So here we have the Keltner bands. The settings I have it as, I use a 20-day average as the basis, and I use a setting of 2 for either side. I use this in TradingView, which is a free platform, but most platforms have Keltner channels in them. So essentially using a 2 parameter for the volatility is somewhat of a defensive stance. In a good uptrend, so you can see here that you'll definitely get above that upper channel if it's the setting is set to 2 in terms of the volatility parameters. However, in a weak trend, that tends to be just about the place where these stocks will stall. So you don't want to use this all on its own, because in a nice bull market, you're going to sell at that channel and you'll see it keep advancing. So you really want to keep this in mind when the stock is significantly underperforming the market. So you can see here the S&P made consistently higher highs and was in a nice uptrend, and whereas Apple was making lower highs during that entire advance. And both times we tagged the upper channel line, was a great place to really sell that stock. And that's really when you want to use this. And you know, to stop and think, Apple's been such a powerful winner, to have been able to sell into strength here, which with such accuracy is a great tool to have in your toolbox. But you absolutely need to use it at a time when the stock is not able to make new highs as the market is making new highs. Here's Apple again. I want to use Apple because this has been such a, again, as I said, an incredibly strong stock over the years. And you'll see here that each time when the market was really significantly advancing and Apple wasn't able to advance anymore, that was a place you want to take some exposure off. Again, here the market did fall, but was back at its highs. Apple was much lower than where it was at its prior high. And so you can see this is another great place if you would have had some stock. I don't know if you would have bought down here, but if you're holding some stock and you say, wow, I wish I could have sold this stock, this would have been the place you would have wanted to do it. Now, the stock consolidated some more. Maybe you were trying to do some buying, but as the market keeps advancing, the stock just can't keep pace with the market. And this, once again, would have been a great place to sell. Now, this is why you don't want to use Keltners all on their own. Here we had this huge earnings gap up above the Keltner, and that completely changed the dynamic of the stock. And from being a stock that was under distribution and being sold into, suddenly this jolt of new fundamental information allowed the stock to stay quite a bit above its Keltner band for an extended period of time. So this is really a time you want to use this sell signal, is when it's underperforming the market. And again, it's not your strongest stock. It's a way to reduce exposure into strength when you don't think you have a leader on your hands. Here's Apple once again. You can see the S&P was very strong here into late 2017, early 2018, with really strong advances, and Apple just did not have the strength that the market did. Whereas the market went significantly higher day after day, this was barely able to advance, and each of these tags of the Keltner was the ideal time to exit the stock. So this is really how you would want to use this technique, with negative relative strength versus the market. Here is Deckers, just so we can take a look at another example that's not Apple related. Deck had a great advance with their UGG boots, and you'll see here the market kept advancing strongly, but really the intense buying had leveled off for Deck. And each time we advanced into the Keltner band here, we had some ideal sell points. If you would have been accumulating some stock on this drop and you can see like, wow, the market really keeps advancing, the stock is not keeping pace, that's the point in time you'd want to do some selling. Again, you can see it also here on the right side. The stock did correct with the market, whereas the market was able to get to new highs way before the stock did, and you would want to be selling in the vicinity of the Keltner band. It's not always the high tick of the move like in these great situations, but selling here at this Keltner channel would have kept you way ahead of the game before you had to sell defensively down at the 50-day or lower. So it still helped you to harvest some profit if you were tactically working the stock in the area. Here is New Relic. Again, this had a major advance prior to this chart forming here, but you can see the distribution phase had begun once we entered this chart, and you'll notice that as well. Most stocks that enter their distribution phase start to stall at this, this Keltner band with these settings. And you see here again, the market continued advancing rather strongly. And if you were sitting with this stock that was a major leader and is no longer advancing, you have to recognize it. And that's why I like to have some of these techniques that are a little more attention grabbing than just a multiple of your risk, because it's possible that you had this really strong stock and you understand the story and you think it's going to have such a great future growth projection. But if you can see the market advancing for day after day for several weeks and your stock can't quite get to new highs, you have to admit that there's something wrong in terms of relative strength, and the best place to sell would be right into the Keltner bands. Here again on the right side, the market was able to make back all of the gains from that late 2018 bear market. New Relic still had been unable to get to its prior high. So if you were sitting with the stock or trying to buy this stock again tactically here, it just persistently kept showing negative relative strength versus the market, and the best place to do your selling would be right up into that Keltner band to harvest whatever profits you did have.